Centene's shocking loss, what it means for the insurance industry. When a healthcare giant stumbles, the ripple effects can shake an entire industry. Such is the case with Centene, a major player in government-backed insurance which stunned investors with a quarterly loss in a sector already reeling from relentless cost pressures. This isn't just a one-off hiccup. It's a symptom of a deeper, systemic crisis that's testing the resilience of insurers nationwide. But here's where it gets complicated. The very programs designed to stabilize healthcare access are now straining the financial models of companies like Centene, Molina Healthcare, and Elevance. And this is the part most people miss. The loss isn't just about numbers on a spreadsheet. It reflects a collision of pandemic-era policy shifts, surging medical demand, and the inherent challenges of balancing affordability with sustainability. Centene's shares plummeted 14.5% in pre-market trading Friday, dragging down rivals like Molina and Elevance, both of which have also raised red flags about escalating costs. The pain isn't isolated to one company. It's a sector-wide issue. Insurers are caught in a perfect storm. Rising demand for behavioral health services, home care, and expensive medications is colliding with the expiration of temporary pandemic subsidies and Medicaid protections. This has created a double whammy. More patients requiring intensive care, while insurers lose the financial cushions they once relied on. Centene's medical cost ratio, MCR, a key metric tracking how much of every dollar goes toward medical expenses, hit 93% in the latest quarter. That's way above analysts' 89.3% forecast and signals trouble across all its business lines. As Morningstar analyst Julie Uttervat noted, the individual exchange segment, where healthier, younger enrollees typically offset costs, seems to be the biggest contributor to the spike. But let's dig deeper. Why is this happening now? The answer lies in the Affordable Care Act's risk adjustment mechanism, which redistributes funds from insurers with healthier populations to those managing sicker, higher-cost patients. A sudden downward revision in Centene's 2025 risk adjustment revenue, combined with soaring Medicaid expenses, sent the company into a 16 cents per share loss, far below the 86% profit Wall Street had expected. CEO Sarah London called the results disappointing, but emphasized the company's clear understanding of trends and commitment to restore our earnings trajectory. That's a polite way of saying Centene is scrambling to catch up. The company plans to request premium hikes for 2026 Obamacare plans in most of its markets, citing an unexpected influx of sicker patients. But here's the catch. Raising premiums risks alienating the very populations these programs aim to protect. Is it ethical to charge more for those in greater need? Should the government absorb more of these costs, or is it time for a fundamental overhaul of risk-sharing models? The stakes are high. Centene's struggles aren't just about stock prices. They're a microcosm of a broader debate. Can the current structure of government-insured healthcare programs survive without sacrificing access or financial stability? As the dust settles, investors and policymakers alike will be watching closely. What do you think? Are insurers like Centene being unfairly penalized for doing the right thing? Or is it time to rethink the rules of the game? Drop your thoughts in the comments below.